Welcome to Financial Management. Today's lecture is about uh, basic concept of financial management. After having this lecture, you will be able to understand the basic definitions of financial management. Uh, you will be able to identify the significance of financial management for finance and non-finance students and from the eyes of professionals. Meanwhile, we will discuss important concepts and areas in financial management. We will also discuss about the position of financial managers in organizational hierarchy and their respective work domains. We will also talk about different types of legal businesses, their advantages and their limitations. We will also discuss different types of financial and real estate markets and some important concepts in the areas of financial management. First, the question arises, what is financial management? Actually, financial management is about the management of financial resources, how we can invest these financial resources, where we can invest these financial resources, what are the investment options, and which option is the best one that can gives us the highest value for our investments, and also financing opportunities in an ever changing and increasingly complex environment. If you look at the balance sheet of some company, there are two major parts of balance sheet. Right side shows the owner's equity and liability, while left side shows the assets of that company. So these two sides actually, financial management is about the management of these two sides. And what is involved in that? Right side is actually about financing and left side is about investment. Assets are your investments, and liability and owner's equity are your finances. For any company, these are the finances where they get cash money to invest into the resources that are assets, and the decisions about these two uh, uh, two different major activities of a company or for a business is financial management. So in financial management, we actually manage the right and left side of a balance sheet. There are many more complex things in this that we will discuss further. Question arises, why we should study financial management. Financial management is the core life skill because everyone need to understand the theory or concept to understand the finance, how to manage finance. It's not only about business, it's also about personal finances. So finance is like a lifeblood for company. Therefore, if we are learning it from corporate point of view, then it's also very important. Then even one company which is going very good, but in business operations, but due to poor financial management policies, the company can get bankrupt. Therefore, management of financial resources is very important. Now we talk about the definition of finance. If you look at the bookish definition of finance, it is the science of managing financial resources in an optimal pattern. Optimal means the best way, the best uh, use of available resources. There are three interrelated areas of finance: money and capital market. These are the securities markets and financial institutions. Securities market like your bond market or your stock markets like stock exchange, and financial institutions are of banks, investments which focus on the decisions of both individual and institutional investors. So investment and investment related decisions are very important and related to finance. And finally, financial management or business finance, which involves the actual management of a firm. There are some important areas and concepts of financial management uh, which we need to discuss in detail. The number one is analysis of financial statement. Analysis of financial statement is a very common technique of financial analysis, and here we perform some financial analysis and we measure performance and financial health of a company and analyzed on the basis of some of its past data or performance. As you are very well aware of some financial statements which are profit and loss statement, this is also known as income statement, and in this statement we uh, um, calculate or we present the operating efficiency or profitability of a company. Here we find out what is the net profit available for shareholders, and this statement also provides the analyst with some insights into the financial performance of a company. Other one is balance sheet. It is a snapshot of organizational financial health for a particular time period, and it shows what assets are owned by business and the sources of acquiring those assets. Another one is a statement of shareholders' equity. Shareholders' equity gives the share of honor in the business. It provides information that how much share is the owner of the business. And the last but not the least is statement of cash flow. Statement of cash flow shows the cash movement in the business, inflow of the cash and outflow of the cash. By having together these statement, they gives us the accounting picture of a firm's operation and financial position. Financial statements they report about the assets, earnings, dividends, all these things over the period of time, usually 1 year. So the analysis of the information in these statement helps to manage the organization to evaluate the performance and activities, and it is also helpful for the investors and creditors to have an idea of the profitability uh, and potential of the business to if they are going to invest in that business or they are going and with the view of creditors if they are going to if they want to check the credit worthiness of the business. Another concept of financial management is investment decision and capital budgeting. Investment decision is very important and they involve a huge sum of money, and these decisions are likely to bring some prosperity in the business. So the company's future income depends on how much investment is made and what type of assets, and how these assets adds to the overall value of the company, adds the value to the company. The second one is capital budgeting. It is also very important and related to investment decision. Uh, Actually, it is related to investment in fixed assets. Uh, Capital, the word capital refers to fixed assets that are used in production. I think you're well aware of this. While budget is the plan, which details or project cash inflows and outflows over some future time period. There are many concepts and techniques that we use to analyze investment decision. Uh, the important one is time value of money. Interest rate is also very important, and it is part of time value of money. Discounted cash flows, net present value, internal rate of return, all these concepts are very important and very fundamental concepts of finance, and we will go through each of them. Another important concept of finance is risk and return. If you talk about investors, either they are individual or they are institutional investors. They invest their money, their cash, with the expectations to earn some return or profit on their investments. So when they attempt to earn maximum return, they are constrained by risk. Risk is always associated with return, and the rule of thumb is that low risk low return, high risk high return, and no risk no return. If you want a return, you have to take some risk. If you will take low risk, you will get low return. If you will take high risk, you will get high return. So when investors they analyze choices, they make portfolios for investment decision making. They analyze risk and return, and so we will discuss this concept here in finance, because we are uh, finance students and we are learning corporate finance with the eye of a manager, because we will go or you will go in some organization and work as serve as manager. So you need to understand these concepts. The important concepts that we utilize to understand and to measure and to analyze risk and return for investments are uncertainty, risk, portfolio theory, capital asset pricing model. We will go through some of these concepts, but will not go through all of these concepts. Some of the concepts are quite deep, and you will learn these concepts in some other subject. The other one is corporate financing and capital structure. When firms plan to expand, they require some funds or capital. So when they want to get funds, uh, like the prime responsibility of a department who is responsible to collect funds or to arrange or manage funds is finance. So there are many ways to get to collect finance. Like we can get in the form of debt, or we can get in the form of equity. Uh, in modern organizations, the mix of equity and debt is used to finance a firm, and it is known as capital structure. So when we talk about capital structure, financial experts they try to find out a combination of debt and equity that could increase the overall value of company. How they will increase overall value of company? By if we get a mix of debt and equity at a very low cost, and we earn highest profit, then of course we will increase the value of the company. So it is known as optimal capital structure, like the best one, the best capital structure, or the mixture of debt and equity with the best blend, with the best ratio, which can gives us which can enhance the value of a company. So the ways to analyze, manage, and go towards the optimal capital structure are cost of capital, leverage, dividend policy, and there are some debt instruments. So we will learn how to measure cost of capital, and what is the role of leverage, how we can increase decrease the leverage, and how leverage will affect the capital structure, and how leverage will uh, route us to the optimal capital structure. Similarly, what is dividend, what should could be the dividend policies, and what should be the dividend policy in different scenarios, and what is the effect of dividend policy to get an optimal capital structure. And similarly, there are some debt instrument, and we will also discuss these debt instruments in detail. All these concepts you need to understand and remember these concepts, because we will frequently talk about these concepts throughout this subject. Another important concept is valuation. uh, the company's assets uh, and their valuation is important for financial managers, and also for creditors and investors. So it helps to understand the value of a company, or to find or to understand that the assets of a company, uh, how the assets of a company are getting value, if they are in an increasing trend or they are in decreasing trend. There are many different valuation techniques that we use to measure value of a company, or different assets of a company. Uh, so here in this subject, we will learn how to find out the valuation of shares, how to do the valuation of bonds, and there are some other financial asset like options. But in our case, in this subject, we will not learn the valuation of options, and also how we can evaluate a corporation. As far as concerned to this subject, we will discuss only valuation of shares and bonds, and we will not discuss valuation of options or corporations. Now move to another concept of financial management is working capital and inventory management. Working capital and inventory management are very important to manage the current assets and liabilities of a company. And uh, actually, uh, it is about to uh, find out the ways how we can optimally manage the working capital and inventory to increase the operating efficiency of a company. And what is working capital? Working capital is about the current asset and current liability. Similarly, if we talk about the role of uh, finance in a business organization, you can see there is the top tier of a company is board of directors, which are elected on by the votes of shareholders, and you have a president of a company who manages a whole company, and there are some vice president for each department, like sales, finance, or operations. Uh, we are concerned with finance. You can see there are two major activities, or two major subdivisions of finance. One is treasury and one is controller. Treasury department is about to manage the credit, to manage the inventory, and to manage the budgeting, and to manage capital budgeting, while controller is about the cost accounting, financial accounting, and tax department. So you can understand treasury is doing some decisions regarding finance, while controller is about to record the financial transactions of the company, either for internal purpose or for external purpose or for tax purposes. Now we move to some uh, types of businesses. There are three major type of businesses: sole proprietorship, partnership, and corporation. Sole proprietorship is also called unincorporated business, which is owned by one individual, and soul means single, soul means a single, or proprietorship is the single owner, who is the handler of the business, who is actually managing the business, and also the owner of the business. And according to one estimate, almost 80% of the total number of businesses worldwide are sole proprietorship. What are the advantages of sole proprietorship? Easy formation. It is very inexpensive, and you can easily form that business. There are no hard or legal bindings for this. Very few government regulations for this. There is no corporate income tax. Whatever you earn, you just have to pay income tax, nothing else. What are the disadvantages? The business, which is owned by a single person, he has some limited capital, so it is difficult to enhance or raise the capital. If you want to raise capital, you need to involve some other people. So if you will involve some other people, this the form of the business will be changed. So in sole proprietorship, if you stick to the sole proprietorship, then it is very difficult to raise capital. Unlimited liability. Liability of the business is unlimited, which means that if you have some losses that exceeds the money invested in the business, you will have to pay by your personal property. Limited life, because sole proprietorship is owned by a single person, so the life of the business is also depends on the life of that individual owner. So the business will be vanished out if the life of that individual is ended. Another one is limited liability partnership. Sorry, the next one is, after sole proprietorship, another one is partnership. What is partnership? When two or more person they form a business and they work together, uh, it could be registered or it could be un. But there is a special type of partnership which is limited liability partnership. Advantages and limitations or disadvantages of partnership is, is almost same like sole proprietorship. But there is a special type of partnership which is called limited liability partnership, is known as LLP. It is a special type of partnership where the owner can avoid uh, limited liability, sorry, unlimited liability. Like as I told earlier, in sole proprietorship, if the business losses are exceeded the money invested by the business, then the personal property will be sold out to pay those debts or those losses. But in limited liability partnership, your personal property will not be hit by the losses of the business if they exceeds with the total value of the business. Other one is and also you don't have to pay double taxation like in corporations. They are double taxation. You just have to pay on your income tax. You don't have to pay some corporate tax. Like there is no tax on business. There is just a tax on your income, personal income that you made by business. Now the corporations, which are in which we are most interested. Corporation is also known as a limited company. It is known as separate legal entity, which is registered by the government, and it is there is there is a separation between ownership and managers. Owners and managers are different. Managers who are managing the business, and shareholders are the owner of the business who buy the common stock of that company. But there are some private limited companies and public limited companies. Uh, Public limited companies are listed on stock exchange, and around 80% of the global sale is about sales of products and services are controlled by the public limited companies or corporations, or you can say corporations. What are the advantages? The life is unlimited because corporations are not, uh, depend on the life of owners. There are many owners, and their shares are transferable, and ownership can be transferable. Therefore, the once you start a corporation, it continues forever, unless it is sold out or not sold out, or unless it is bankrupt, and it is not possible for that company to run the businesses. Transfer of ownership is very easy. You can easily transfer ownership. Limited liability, if the losses of the businesses are beyond the value of that business, shareholders will not, the personal property of shareholders will not be hit. Ease of raising capital, yes, it is very easy. You can uh, 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 launch some new shares, or you can go to the bank to get loan. Also you can issue some bonds to get money. So there are many ways for corporations to raise capital, because these are registered businesses, and these are very big businesses, and they have lots of opportunities, and they are very uh, uh, sophisticated markets for corporations to increase their capital, to raise their capital. What are the disadvantages? The major disadvantages advantage is double taxation. You have to pay tax two times. Once you have to pay corporate tax, and second you have to pay income tax. Like the company, whatever company earns, they have to pay corporate tax on their earnings. And when they pay corporate tax, after paying that corporate tax, whatever they have, that would be distributed among shareholders in the form of dividends, and those shareholders will pay income tax on their dividends they received. Another one is cost of setup. The business is very high. It is very very costly to set this type of company, because there are many official documents, and many complex requirements that consume time, money, resources. Therefore, these are two major disadvantages of the business. Now we move to financial markets. Two major markets are capital markets and money markets. What are capital markets? Uh, Capital markets are the markets where long term debt and stocks are traded. One example is stock exchange. You might aware of this. Stock exchanges are the market where companies where we can buy and sell the shares of companies. Those are listed in stock exchanges. And the other one is long term debt market, bond markets. uh, these are the markets where long term or corporate bonds are traded. So uh, these markets where these two type of uh, uh, financial assets are uh, traded are known as capital markets, and the markets where short term financial instruments are traded are known as money markets. uh, here short term bonds are traded, uh, call options, interbank short-term lendings. It is also known as overnight lending, borrowings, leases, insurance policies, certificate of deposit (CDs). All these types of products, where these type of products are traded, are known as money markets. So banks is also an example of money market. As you know, there are some real asset or physical asset markets. So, where the market where we exchange cotton is called cotton market or cotton exchange market. There are some gold markets, there are some clothes markets, there are some property markets. There are also some markets where we go and buy and sell computer hardwares. There are some used car markets, also wheat, sugar, vegetable market, which is known as Gala Mandi. So there are markets where we can trade real or physical assets, but there are also some financial markets where we trade financial instruments, long term or short term. Where we trade long term assets are known as capital market, and where we trade short term financial instruments are known as money markets. Now we need to understand the difference among financial management, economics, and financial accounting, because usually students are confused about the concept of finance, and they think that finance and accounting are same, or finance and economics are same. So we need to have some idea about these three different fields. Although these three fields are interrelated, but there are some differences among these fields. So the objective of economics is profit maximization, and they talk about profit maximization with the eyes of individual, for the society, for a particular group, or in terms of global. Uh, and In capitalist economics, we also study about individual or company's profit. While in financial management, uh, actually financial management is quite focused, not broad like economics. We talk about maximizing the wealth of shareholders, and financial practitioners usually use the discounting and the net present value techniques while calculating the increase in the wealth of shareholders. So here we discuss the actually we We discuss about the wealth creation of owners of the company, and we use different techniques to enhance or to increase the value of shareholders. And objective of financial accounting is to collect, summarize, organize the financial data and financial information to make to arrange it in a consolidated form where they can present it in a systematic way in the form of some accounting reports which are known as accounting financial statements. And these statements are used to understand the financial position of the company. And also also these information support the financial managers to take decisions about some future future op- they help financial managers for future decision making, because we need financial data to take future decisions. That's all from today's lecture.